Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Welcome to our latest financial education video. Now it is tax season, so I know you got taxes on your brain, so I wanted to come up with a good video on some tax saving tips. I found this great article that shares 6 specific strategies that you ought to look at when you're in retirement, but you could also start deploying even before retirement. So let's get started. Alright, so before we get into the 6 strategies, let's talk a little bit about how to frame this conversation, and it's really a mindset change. So if you think about it, there's a lot of things that change in retirement, and you have to kind of change how you invest and also the way you look at taxes. And so I want you to look at it this way. Before you're retired, your biggest goal is to try to minimize taxes as much as possible because you're earning wages and you're normally in a higher income tax bracket. So lowering taxes is usually on the front of your mind. But when you're in retirement, it's more about reducing the lifetime income taxes, the lifetime of taxes over the next several 20, 30 years. And so let's take a look at an example of how that would work. Okay, let's say you are in retirement and you have 2 accounts. You have a Roth IRA and a traditional IRA. All right, and your goal is to just purely minimize taxes today. So what's going to happen is you're going to want to withdraw the money out of the Roth because the withdrawals out of the Roth are going to be tax-free versus the traditional IRA, which are going to be taxed at ordinary tax brackets. All right, but what's the result of doing this? If you do this, what's going to happen is your Roth IRA is going to get depleted. And then in your latter years, you're going to be dependent on taking more and more out of the traditional IRA to make up for it. And so the problem with this is that you're going to end up paying much higher taxes later, and you won't have that Roth IRA to help mitigate some of the taxes. So as a total tax bill over your lifetime, you'll end up paying more in tax rather than doing a little bit of both. So the trick here is to try to pick a tax bracket that is not too high, not too low, that you could always try to be in so that you can even out the tax bill over time and over your lifetime pay less. Now, how do you do that? Let's talk about that next. Alright, so the process is pretty straightforward. It's 3 steps. First of all, you take a look at your early years in retirement, maybe before you start taking Social Security, especially before your minimum required distribution ages. So this is usually somebody who's going to be in their maybe mid-60s, late 60s, even early 70s. Alright, usually your income's going to be lower because you won't have Social Security and all those minimum required distributions kicking in. So that's probably when your tax bracket's going to be the lowest it's going to be in a long, long time. Then step 2 would be to take a look at the other end of the spectrum. Now you're taking Social Security. Now you're doing your minimum required distributions. You got a lot more income coming in, and so you're going to be in a higher tax bracket during this time. And so step 3 would be to find that ideal target kind of in between 1 and 2. Not too low and not too high to try to target so that we can more evenly distribute the taxes over your lifetime. Alright, so the first strategy is making Roth contributions. Now this is most helpful actually before retirement. And so usually you're going to be making, those contributions that give you those tax benefits. But there's a little wrinkle in here. What if you actually go into like a transition to retirement, where maybe you just go from working a normal 40-hour-a-week job and you start to do consulting and you work fewer hours and your income's a little bit lower. So in those kinds of situations, it might make sense to think about adding to a Roth IRA instead, because the benefit of getting that tax deduction is not as great as it was before, and so the benefit of the tax-free Roth might be a better way to go. So that's strategy number 1. All right, so strategy 2 is to take a look at the Medicare surcharges. So Social Security, what they do is when you are going from working into retirement and you apply for Medicare, they look at your last 2 years of your income. And if you were working in those last 2 years, you're going to have a much higher income most likely than when you are in retirement. And there's several reasons that you can actually ask for an exception for them to look back and change what that surcharge is. There's a form that you can fill out to request that. And one of the exceptions is for a work stoppage. So you may want to take a look at that if your income dramatically goes down in retirement. And then there's strategy number 3, which is a very powerful one where you're doing Roth conversions. So this is especially powerful when you're in those lower income years. You can actually take some of your traditional IRA and convert it to a Roth. You end up paying some taxes when you do that, but you're doing that when your tax bill is probably the lowest it's going to be in retirement, and you're shifting more into the tax-free account and also reducing the mandatory amount that you're going to have to take from the traditional IRA later, which would be taxable. All right, strategy number 4, portfolio structure. Now this is really huge. A Roth IRA growing tax-free, if you think about it, that's where you want to put your more aggressive investments. You want to invest more in stocks and less in bonds and those types of accounts because it's growing tax-free. You want more money there. And in the taxable account, maybe that's where you can be a little bit more conservative, put a little bit more in cash and bonds, maybe a little bit in stocks, but not as much. And you could do the same thing with a taxable account. It's not as good as the Roth, but it's still better than the traditional IRA in the sense that when you sell your stocks out of your taxable account, you're dealing with capital gains rates. And capital gains rates, now of course this could change, but for right now it's actually lower than ordinary income tax rates, which you would pay when you withdraw money out of a traditional IRA. The other nice thing about a taxable account is when you pass away, again, this can change, but for right now, you have a step up in the cost basis that happens to go to your heirs. Meaning that if you buy a stock at $1, it's worth $10 when you die, your heirs inherit it at the $10. That's what's called the step up in cost basis. So it can help a little bit as far as taxes for your children. So portfolio construction and structure is very important. Okay, strategy number 5 is qualified charitable distributions, or QCDs. Now these have been very popular lately because they work out very nicely. What happens is you have a minimum that you have to take out of your IRA every year. Okay? And let's say you have a $80,000 withdrawal you have to take out of your IRA. But let's also say, no, this doesn't always happen, but if it does, this could be a great strategy. Let's say you don't need all that money. Okay? But you have to take it out anyways. And normally when you take it out, you'd have to pay those taxes. Well, what if you would give some of that money to a charity? Let's say you gave $10,000 of that $80,000 directly to a charity. It would still count for your minimum required distribution, so the IRS would be happy. But that $10,000 that goes directly to the charity would not be taxed. And so that's a beautiful thing, especially now that a lot of people don't get any kind of deductions for giving to charities because they're just taking the standard deduction today. This has been a very popular strategy. All right, and the last strategy is creating a balance of your accounts. Now, this is something that you could take a look at before you retire. And I've seen this happen before, especially for those higher income earning pre-retirees. They get so enthusiastic about putting money towards these tax-deferred accounts that they can have these unintended consequences of growing these tax-deferred accounts way too large. And what happens is if you get into this situation, you could have these very large minimum required distributions later in life that push you up into very, very high tax brackets. So it's important to kind of look at the projections of what your account balances might look like over time. And if you see that it's going to push you way up into these really high tax brackets, you may want to tone it down and make some other contributions to things like a taxable account or maybe even a Roth. There's some ways that you could do that, and that could help you basically diversify your tax buckets in retirement. And a good CFP financial planner can take a look at those projections with you. All right. So I hope this helped, guys. I know this is a lot of detail. And again, I'm not giving out tax advice. This is just general tax information. But I hope you found it helpful. And if you want to follow up with me on any of these points and to see how it affects you or how it relates to you, I would be happy to do so. But thanks for watching. God bless.